What's up, YouTube? On today's episode, part 2 of TSP for beginners, we're going to go through the different investment options you have in your TSP account. Hi guys, it's Kevin Al from Infinite Wealth. Today we're going to be going through the different investment options that you have available in your TSP account. If you missed part 1 of the video series, make sure and go back and check that one out. We went through different ways to pick your asset allocation and then explain why this is the most important decision you have to make, which can account for up to 80% of your investment returns over time. In today's video, we're going to go through the different investment options that you have available to you in the TSP. In part 3 of the video, we'll start building a portfolio that's designed just for you, customized to fit all of your risks and your needs for your future for the money. And then finally in part 4, we will go through some different maintenance things that you have to do to maintain your TSP over time. Now don't get worried, this is probably 15 minutes of work every 3 months is all, but it is something that is necessary to make sure that you maintain the asset allocation that you decided. And then you're going to change the asset allocation slightly over time as you get closer to retirement. Okay, so let's go ahead and jump right in. We'll get on the computer and we will go through the different investment options that you have available in your TSP.
Okay guys, you'll want to go ahead and log on to the tsp.gov website. I'll put a link to this below in the description if you do not know about the website. When you start employment, you should have gotten an account number mailed to you. And then you'll also get a separate mailing with your password, and you can go ahead and set up your account and then create an individual password for yourself. So first you'll want to go to investment funds. We're going to go to fund options. Now, life cycle funds is a choice. You just pick a retirement year and they just pick the different fund mix for you or your asset allocation for you. That's not what I teach. A lot of people in the investment industry have described the life cycle funds as L for lousy. I would kind of agree with that. You want to make sure that you have an asset allocation that's built just for you. These are pretty general and they won't factor in all your different risk tolerances, what your needs are in retirement, what kind of savings you have, and other personal factors. They don't factor those in. But what you can always do is go to a lifestyle fund that's similar to when you're going to retire. So I will pick L2040 because I'm about 20 years away from retirement. And then what you can do just to get an idea of an asset allocation of what the TSP lifestyle is. And then what you can do to just get an idea of the asset allocation that a TSP lifestyle fund for you would look like. It's got 20% in G, 7% in F. So you're at about 28% in bonds. You have 35% in C, 10% in S, and 25% in I. So what I'm going to teach you to do is when you pick your asset allocation, you're going to pick these percentages based on your own particular situation, just to make sure that your portfolio that you build is right for you. So the TSP is an index-based retirement plan. So all that means is that these funds are not actively managed. They just track an index, which is a very good way to invest your money over the long term. It's very tax efficient and it's very efficient as far as fees. We'll get into some of the fees later, but you pay hardly any fees on your TSP account. So your first investment choice you have is the G fund, G like Gary. It is a special fund exclusive to the TSP. It's a short-term United States Treasury security that is specially issued to the TSP. So this fund does not have a lot of risk involved with it. It has over time beaten inflation, but just by a little bit. So we will look at this fund in our asset allocation. Next fund is the F fund, F like Frank. So that's a fixed income investment fund. So this fund actually tracks the Bloomberg Barclays US Aggregate Bond Index, which is a broad bond index. So this is the primary one that is tracked in most index investing strategies. So this is a very good fund. This will be where you get most of your bond exposure. If you are a beginner and don't know about bonds, bonds tend to, as the interest rates go up, your price of the bonds go down. So there is an inverse relationship. Just keep that in mind. The Federal Reserve has been raising interest rates, the short-term interest rates over time, but we are definitely in a very low interest rate environment. So over time, as inflation kicks in and they raise the interest rates more, you could see some losses in the bond funds. Since this is a bond fund, it has much smaller risks than a stock market fund. So over time, you will not make as much return on it, but also you will not lose as much in general on a bond fund as stock funds. It does go through the different risks and rewards. Just go ahead and read through those. But just keep in mind that the G and the F funds, those are your two bond components that you have when you build your asset allocation. The next fund is the C fund, C like cat. So this fund tracks the S&P 500. So this would be the 500 largest companies in the United States. So this is a broad market index. So it's large to medium-sized companies. So your Apple, Google, Walmart, a lot of the companies that you've heard of. And then it gets into some more medium-sized company. So since this is a stock fund, it is a more volatile investment because you have more risk when you invest in stocks. So you can get higher returns, but then also during market downturns, you can get more losses in the S&P 500 or the C fund. Next up, we have our next stock fund, which is the S fund, S like Sam. It is a small cap and mid cap index fund. So basically there's 5,200 approximate US companies listed on the stock exchange in the United States. Your C fund invests in the top 500. Your S fund has an index of all of the bottom 4,700 companies approximately. So these are the smaller cap stocks. Now, just from your perspective from investing, the C fund will be less risky than the S fund. So over time, the S fund is expected to return more as a percentage of your investment, but just know that it will be more volatile. So maybe it's up 40% sometimes, maybe it's down 40%, and it's going to go up and down more violently than the C fund. Then finally, we have the I fund, which is the International Stock Index Investment Fund. I like India. The I fund tracks the MSCI EAFE, which is Europe, Australasia, and Far East Index. So this will be the rest of the world outside of the United States. Now this is also a stock fund, so it will be more volatile than a bond fund. And then you have market risk and inflation risk in this fund, but you also have currency risk. So you are spending your monies in US dollars. So if the US dollar decreases or increases relative to the values of the currencies in the countries, that will affect your investment. Now in part 3 of the video, we will start talking about portfolio construction. But in general, it's recommended to have at least 25% of your stock portion invested in international. And then you can go up to 50 to 60% if you're a very aggressive investor. Next up, we're just going to kind of look at the performance. Now keep in mind with these performance numbers that this is just the last 10 years. So it's been a very unusual market. It's mostly went up. We had the huge crash in 2007, 2008, but this is tracking from 2009 to 2018, which for the most part, the markets have only went up. So if we look at the annual returns, you'll see with the G fund, you're anywhere from 1.5% to 3%. So inflation usually runs 1.5% to 2%. So you're probably getting a little bit more return than inflation. So 1 year 2.91%, 10 year 2.30%. So as you can see, any money you put here is safe, but is not going to get a huge return for you. Next, we have the F fund. If you look at the F fund, it's more volatile. So as I said, as interest rates go up and down, you will see that the fund returns go up and down more on this. And even in 2013, we had a small loss in bond funds. 2015, you had a small gain. So if we look at the actual numbers here, so the 1 year of the F fund is 0.15%, so you haven't made a lot. And the 10-year average is 3.73%. So if you look at $100, inflation has went to 220. This fund has went 616. So over a 10-year time span, any dollar you put into the F fund has returned more than the G fund over the last 10 years. But just keep in mind that the last 10 years has been unusual. Next up, we have the C fund, which is the S&P 500. Now, if you look at this, the annual returns are up to in the 30% range. You did not see that in the F fund because bonds generally will not do that, especially the shorter term bonds like the F fund. But then if you look at the past 12 months returns, it's been very volatile. So some months you've lost almost 10% of money. Some months you've gained back the 10% of the money. So that's where it's important to have an actual plan and to stick with your plan. So if we look at the 1 year on the C fund, it is down minus 4.41%. So we did lose some money in 2018 and part of this year. But if you look at the 10-year, it has averaged 13.17% in your return. Now again, keep in mind that these last 10 years has been unusual. That's a very high return. You will not get that return over the next 10 years. But just for an example, if you had $100 invested 10 years ago, it's worth $1,927 now. So you can see if you can ride out the volatility of the stocks, you will get much higher returns than bonds. The next up, we have the S fund, S like Sam. So the small cap stocks tend to be much more volatile than the large caps. So they've been pretty flat to down 10 to 12%, up 10 to 12%. As you can see on this chart, we've had returns up to 39%. And then we've had years where we didn't have much return, and then we had negative returns. So on the 1 year, it's minus 9.26. 3 years, 7.67, 5 year, 5.49, 10 years, 13.67. So that is pretty similar to the C fund. In general, the S fund over long periods of time should return about 2% more than the C fund. But you're talking 25 to 30 year periods. So if you do select to have the S fund, and everyone probably should have a certain percentage of it, just make sure you stick with that percentage. You keep rebalancing and you keep adding money in even when it's down. Over long periods of time, you will be ahead with this one. Then finally, we're going to look at the performance of the international funds. And then finally, we're going to go through the international fund. As you can see from the last 12 months, the internationals have not had a good year. They've lost money most months. And then some months they've gained some money. And then this last month has been very good for them. But you can see that you can get up to 31% annual return on them. And then it's kind of flat down here. Now, they have not had the same type of recovery that the United States has had in the last 10 years since the 2007-2008 decline. So these funds are valued lower. So over time, chances are that they will catch up to us at a different time. This is called diversification. So if you actually have our funds and then their funds that maybe aren't doing as well, if you rebalance into the funds over time, you're going to make more money than owning just one of the funds themselves. So at the 1 year, we're down 13.43%. 10-year average, 6.48% return. So even though they've been not the best performing and haven't returned the best, they still have beaten the bond fund over the 10-year mark. So do keep that in mind. That's it for a quick overview. The TSP fund, its beauty is in its simplicity. You only have 5 funds that you can invest in. And then I will teach you how to pick the right asset allocation and have a proper investment policy statement written just for you on the next video.
All right, guys, that was a quick overview of the different investment funds that you have available in the TSP. So just keep in mind, G fund is the less risk and it will have the least amount of return over time. The F fund is your bond fund, so that one will have a lower return, but it is more stable, so you have less chance of losing money in that. C fund tracks the S&P 500. S fund would track your small cap stocks. And finally, your international fund, it will track the index that's everything outside of the US, so all your international stocks. What's so great about the TSP and the funds in it is you have 5 simple funds. They're at a very low cost, so they're at 0.04% on your expense ratio. So that means you're spending $4 on every $10,000 invested per year for your fees, which is extremely low. So any of the money that you're putting into the TSP is mostly going to you, and it will compound over time. I would suggest spending a little time reading about each of the funds on the TSP website. There is some good information there. It's worth it to learn about the funds. And then stay tuned for part 3 of the video. We're actually going to go into an asset allocation, and we're going to build the portfolio that's built just for you. Thank you for your time watching this video. Thanks for sticking with me all the way to the end. If you did like this type of video, leave a comment below. If you have any questions, leave it in the comment sections. I will try to answer it for you. And then finally, if you did get some value out of this video, please subscribe to my channel, ring the bell so you get notifications. I'm going to have a lot of videos coming up here shortly, just in the leadership, lifestyle, and investing realm. So there's going to be a lot of good information coming up. I've got some great plans for videos once I finish this series out. So stick with me, subscribe, comment, and thank you so much for watching.
Tell me pretty lies, look me in the face, tell me that you love me.